Good morning, everyone. This is Rakesh here. I hope you're able to hear me clearly. We're just waiting for a number of our participants to join in, and probably in about a minute's time, we will kickstart the conversations. Thank you so much for all those who have joined in early on time with us. We look forward to a engaging and a fruitful discussion. I can see the numbers pouring in. So just give us another minute. So I think let's begin the conversations. We have a number of participants who have joined us today. So thank you so much. Good morning. We will be taking this session on about 4 topics, as we mentioned in our invite. We'll be covering something interesting on place of effective management. I call that as a GPS of international businesses. We'll talk about tax residencies. That is one of the most prized certificates that companies or individuals can borrow from the FTA if they can. And that's where sort of my colleague will speak about what are the nuances. We'll be speaking about interest deductibility, which is, I think, very close to a lot of businesses over here in terms of how they fund their operations and how they plan for their debt equity ratios. Thereafter, we'll end the session with a bit of entertainment, and not literally so, but how does the UAE Corporate Tax law deal with entertainment expenditure? With that, let me just introduce the speakers today with you, and a bit of housekeeping rules, and then I'll hand over the conversation to my colleague. So with you today, myself, Rakesh Jain, partner corporate taxes, based in the UAE. I'm joined by Sandeep, associate partner corporate taxes. I'm speaking with all of you after a bit of a hiatus. We've had the last webinar a few months back, then we've had a couple of client events, and happy to be back. We will be doing this a lot more as we come close to the end of the year, and through knowledge sharing sessions, through thought leadership publications, and so on and so forth. We welcome your feedback on what topics and subjects that you would like to hear from us, and we'll be happy to pick those up as we go along. Sandeep is an experienced partner. I tell him a guy who knows the tax at the back of his hand, but more importantly, he's a guy who can explain tax even to a child. So that's something that we'll have fun with today when we listen from him. With that, let's just quickly go through the housekeeping rules and the agenda, and then I hand over to Sandeep. So about an hour with us. Submit your questions in the chat box. We will try and answer those questions after the session is over individually, as and when we can. The webinar is being recorded, and hopefully it will be up on our website and other handles very soon. So I spoke about the agenda. In terms of how we are looking at presenting this, Sandeep will be speaking about place of effective management and tax residency, and then I'll come in to speak about interest deductibility as well as entertainment expenditure. So with that, Sandeep, over to you.
Thank you, Rakesh. Good morning and a warm welcome to everyone, to all the participants who are attending this webinar. Thank you for taking your precious time out for this. Today also happened to be an auspicious day of Diwali. So those celebrating, wishing you all a very happy Diwali. Rakesh indicated about the place of effective management. It's a very critical topic. And what I'm going to take you through today is basically the detailed guidance that has come through the tax guide that has come through. FTA has devoted 20 odd pages on this concept, detailing upon as to what constitutes this effective management. But before I get into this detailing of what the guidance is now stating, I think I need to spend few minutes as to how this concept has evolved in the context of UAE corporate tax law. Let's understand its importance first, and then you will be able to appreciate that why this concept itself is so critical enough for businesses to revalidate, to recheck. The FTA came out with the definition of resident person. Of course, you need to charge people to tax. Based on that, you need to come out with criteria. As part of the resident person definition, you have a concept where a foreign company could also be treated as a resident person in the UAE if its effective management is based in the UAE. Now, this is coming through Article 11.3 of the UAE Corporate Tax Law. Now, the question now comes here is that how do I decide that I have an effective control and management in the UAE? And this is where the most obvious thing is that you look for the guidance that the Federal Tax Authority would have issued in this regard. So if you look at this, and why this concept becomes important is something which I'm just spending 30 seconds more on this. Once you are a resident person in the UAE, then your global income gets taxed in the UAE. Now just imagine, for a UAE incorporated entity, this still seems plausible. If you are incorporated here, you're bound to pay taxes here on your income that you're earning in the UAE and outside of UAE. That's basically has been the international concept. But if you ask a foreign entity, which probably might have been paying taxes back in their jurisdiction where they've been incorporated, if you determine by way of your local legislation that they also happen to be a resident in the UAE, then it's a double whammy for them. They may treat it to be a dual resident, and there could be a lot of complications that could arise through. But the key part is, you being a foreign entity and having a POIN in the UAE, you could be subject to the global income in the UAE, which is something that the companies are, particularly when I see at a UAE market level, since it acts as a regional headquarter, it has created a lot of hue and cry and a lot of concern around this. And that's where, when this concept came through, the first thing that we looked at was, is there any guidance available under the Federal Tax Authority regime for us or for the clients to evaluate how this POEM needs to be tested out? That's where we relied upon the explanatory guide that came down in May 23. Now, May 23 guide was giving us broad principles as to how a POEM operates. If I look into those factors, which were the principal factors which were indicated there, it talks about the place where the board of directors resides. Now, this is a very important aspect, and I will correlate this aspect to you because the recent guidance that has come through, it addresses the where part. Similarly, the question also comes as part of those principles that where the board usually convenes, who basically convenes your decision making. If it's the board, then of course that board comprises of your effective management. So there are certain parameters that this May 23 guide was elaborating on. Before the businesses could have expected something detailing coming out of that, we got to know that the guide was repealed. Now the question remains still, what I need to do. Should I rely on the guidance that has been repealed and should I just move on? Or should I wait for the FT to come out with the new guidance? And this is where the CT General Guide, which came down in September 2023, was a welcoming from the standpoint of the taxpayer that yes, something would have come through. Now, once you look into that September 2023 guide, CT General Guide, it more or less elaborated the same principle which was being spoken as part, or which was being elaborated as part of the explanatory guide in May 2023. The only peculiarity that happened in September 2023 guide was that it emphasized the concept that while you may have a day-to-day management anywhere or multiple places, but for POEM, it has to be at one place. This wasn't sufficient from the standpoint of the businesses, I would say. They would needed any jurisdiction when coming out with this kind of a concept where you're trying to tax an income of a foreign entity. There has to be a in-depth rule for a taxpayer to evaluate. And that's where in Feb 2024, the registration mechanism was released. Now, when the registration decision came through, the question was, if I perceive as a taxpayer that my foreign entity might have an effective management in the UAE, should I be registering myself? Now, to this extent, it created a lot of confusion, I would say, because if you look at the decision basically classified the registration aspects for companies incorporated after 1st of March 2024. This is when the decision was made effective, or the companies that were existing prior to 1st March 2024. If you look at the decision very clearly, for foreign companies having a POEM in the UAE, the aspect of getting themselves registered in the UAE was spoken very categorically as part of entities incorporated after 1st of March. There, the due date was given to be 3 months from the close of the financial year of that foreign entity. Mostly for calendar year companies, if I need to speak about, this will come as 31st March of 2025, considering 2024 is the first year of tax. However, you couldn't see anything of this sort, which is very categoric to POEM for the companies which were existing prior to 1st March. Now, that raised a doubt. If I assume myself as a regional headquarter that my foreign entities might have POEM in the UAE, should I assume the 31st May to be the deadline for such entities to be registered? Or technically speaking, since the FTA decision was very categoric after 1st of March, so I should be looking at the POEM for these entities when the year is lapsed and if I see that the POEM existed throughout the year. Two views were prevailing in the market. Should we get ourselves registered, not get ourselves registered? But of course, the inclination that went was, since it just needs to be tested out throughout the year, let's wait for the year to get over before somebody seeks a registration on its own. Now, to our surprise, when the 31st May deadline went through, in the first week of June, we had this public clarification that came in. In few of the examples that the clarification took through, one of the example was indeed in relation to POEM, where the language of the examples was suggesting that if the taxpayer believes that if it is having a POEM in the UAE, then technically speaking, your registration timeline was 31st of May. Clarification coming in the first week of June, saying that the timeline was 31st of May, of course, was something which the taxpayers were panicked because there was a penalty risk of 10,000 dirhams, which indeed remains as is because the clarification has indicated that you were supposed to get yourself registered if you believe you have a POEM in the UAE. While the earlier 31st May deadline, taxpayers were assuming that it might be for those offshore Java companies which do not require a license. Maybe the POEM was not covered, but through this public clarification, it was made abundantly clear. Now, once it was made aware that you are sitting on that risk of not admitting a POEM on your own, which means you need to register yourself, one was certainly looking for some detailed guidance as to carry out this analysis. And this is where, when we were thinking that now, since the guidance and since we are 2 months to the close of the financial year, which is the first tax year, let us just use the international best practices to evaluate for these companies who are facing this kind of a risk to undertake that analysis based on the international guidance. Then fortunately, in October 2024, we have this tax residency guide that came through, which has now devoted 20 odd pages as to how the POEM concept should be treated. This is where I will now take you through what those 20 pages entail. This background is indeed needed for you to understand this in detail. Now, if you look at the concept of a POEM, it says place of effective management. Then it says the effective management. What does it mean? It means where the key management and commercial decisions, okay, key management and commercial decisions necessary for the conduct of the business as a whole and in substance are made. So the decisions have to be key management and commercial. They have to be necessary enough for you for the conduct of the business that you are in, and as a whole and in substance they are made. Principles laid out are very clear that the approach or the guidance that has come through has reconfirmed that this concept is substance over form. We need to see what the substance lies in terms of the decision making. And that is where, if you look at the guide has indicated principles as to, and these are inclusive. Please don't treat them as an exhaustive principles. They have given you an indicative list. The inclusive principles that the guide is now indicating, the actual decision making, which means if you are setting up your general policies and strategic directions for running the operations of an entity, that would be a key management and a commercial decision. If you are deciding on the type of transaction, whether we should merge, whether we should demerge, whether we should acquire some company, if these are the critical decisions, of course, these are key management and commercial decisions, which basically from the standpoint of the FTA, when they came out with this indicative definition for you, if you are appointing the C-suite to run the affairs of the company, your CFOs and the CEO, the senior executive people, that for sure is a key management and a commercial decision. If you're overseeing the day-to-day operations of the persons who are managing your day-to-day affairs, that also is a key commercial and management and a commercial decision. And last but not the least, what they have spoken about is how you handling the finance matters, which means how the profit needs to be distributed, in terms of how the declaration of the dividend has to happen, how the profit needs to be reinvested. If these are the decisions they're taking, they may tilt towards the key management and commercial decisions. What doesn't, from the standpoint of FTA and in general parlance, that when they came out with this guidance is, doesn't constitute the commercial and the management decision is, of course, if it's a day-to-day conduct, as I spoke to you about, if it's a legal and an administrative matter, if you're only merely implementing what has already been taken at a strategic level, you're just ensuring that the decision gets implemented. If you're just formally approving the decision, then of course, this is not something that you have done as part of the strategic part. You're just formally approving the decision. So it may not be considered to be a management and a commercial decision. Now, question comes, you may have effective management, and I indicated you the September 23 guides brought out this principle that you may only be having one poem, but you could have a situation where you could allege and you could say, no, I may have multiple poems. These decisions have been taken respectively in many other jurisdictions. Now, to that extent, the principle that is coming out is predominantly and regularly from the place from where you take these decisions matters a lot. Okay. Now, keep this key commercial and management decision in your mind while I'm moving into the next slide, because that's where now I'll take you through as to how the FT has dissected this concept for you. As I said, the dissection has happened under the two broad parameters. Who takes the decision? Okay, which is a very obvious thing. Who are these people who are taking the decision, and from where these decisions are taking from? Now, while this seems to be two squares, which seems to be obviously very simple, but they're not simple as such, because that is where the FTA guide is now elaborating on the who test. Under the who test, they have come out with three aspects. They are saying the board of director test. I'll speak about how the board of director test comes into play in this overall context. Second, the delegation of authority test, which is again under the who umbrella. And finally, the shareholder activity test. Now, obvious thing, we are thinking on, since this is a commentary on poem, one has to understand the logic. As I said, the principle which the FT has come out is very clear. They want to see the substance. Who are these people who are taking the decision? And that is where the way they have begun in their guide is very obvious to say that if you are a foreign company, it is an underlying or an implicit assumption that you're operating under a statute or a regulation. Like companies under the UAE are governed by the commercial law. Similarly, a foreign entity would be governed by its own law, where you have its own charter documents, you have memorandum of association, you have articles, you have constitutive documents. See in those constitutive documents what sort of powers and to whom those powers have been given. If the powers have been given to where a board has been constituted and the powers have been given to them, this is where the base or the premise will start. But FT has gone one step ahead. They're saying, from a legal perspective, once you have undertaken this and once you've decided this, yes, XYZ are my people who have been given the power to decide or to take actions on behalf of the company. The question comes, the people who are having that power, are they actually exercising that power? That's the one test that you also has to see. If they are not exercising the power, then the question comes, who are the ones who are actually exercising this power? Which means, in a way, you're lifting the veil to see who exactly is taking the shot. That is what the board of director test then delves down into the delegation of authority test. Because the moment I say, while you may have the legal power to take the decisions, but still you're not taking the decision and somebody else is taking a decision, that somebody else means either you have delegated that somebody to take such decision, and that delegation could come in the form of a executive committee that you may have formed. You have a managing director who has those powers, right? This is where this flow of the delegation of authority will come into play. Now, the FTA has not stopped here. And that is where we see that this is a very factual exercise. Please do not treat these tests to be applied blindly. Each of the fact pattern may be unique in our client cases. They have to be mapped and reconciled based on what your actual fact pattern is. But the fundamentals, how they've been elaborated, is the key here where we are, basically having this conversation about. The third part comes to the shareholder activity test. Now, it may so happen that board may merely be acting, and that's the concept which I would not say the concept, that's a referencing that has come in the guide again and again. The board may be a rubber stamp. It should not be a rubber stamping when it comes down to this. You need to find out who are those actual decision makers, and it may so happen that the shareholders may be undertaking that kind of a role where they may be exercising the control over the board. Now, if there is a situation where the shareholders are exercising control over the boards in terms of the critical decision, then the poem needs to be tested out. Your who in this case happens to be your shareholders. Okay. So when I consider the who test in summary, the board of director test, they have, of course, they have given certain parameters, and I'll just explain them very quickly to you. And they seem to be very obvious to me when they speak about. They say in terms of the context of a decision which the board is, which the board is taking, how qualified and experienced your board members are. Do they have sufficient knowledge of the decision of the business decision that they are, that they're taking? If that becomes an important and a determinative factor for us to assess how independent or autonomous the board is, because that's one of the reflections, that if you are competent enough to take a decision, you have experience enough to take a decision, then we are in the right spirit. Now, are the board only acting on the instructions which have been provided from another person? That's the test where the shareholder may come through, or the delegation of authority of part may come through, which I've just spoken to you just a few minutes back. And of course, we also need to see how the board composition is. You may have executive directors in the board, you may have non-executive in the boards. Executive directors are expected to be involved in the, in the decision making. Non-executives may not be involved in the decision making, and that's where the composition of the board also becomes an important aspect. Now, when it comes down to the delegation of the authority test, of course, as I said, it's factual. It needs to be seen on case to case. You need to see the person who are in charge. Have they taken control? Are they in implicit control of the board in terms of these decision making? If the outcome comes out to be yes, and how do you determine this? Whatever outcomes or recommendations which this delegation presents to the board, if the board just merely accepts it, then definitely the decision making is not done through the board where the board is sitting. The decision making is done through this delegation where this delegation is sitting. That's where the distinction coming out to be. And that is where it is very critical to evaluate. When it comes down to the delegation authority test, one has to be very clear as to what sort of decisions are being taken. Are they being taken from a standpoint that they are being critically discussed by the board? The board is basically evaluating those decisions and saying, no, we don't agree, or we are agreeing in certain situation. If the answer is that every time whatever is being recommended to them is getting approved, then of course it's a red flag. And that's where one has to test this out. And lastly, when I speak to you about the shareholder activity test, generally the guide will indicate you to say shareholder functions are there. Of course, when you have to liquidate an entity, when you have to raise new capital, all these decision makings will have the shareholders coming in, and they are the ones who basically appoint people to control the business. But these functions in the context of the poem may not be relevant. What is relevant is that whether these shareholders, whatever decision a parent company would have taken, if those shareholders are able to exercise the control over that decision making of the parent, then definitely one has to see and lift the way to see what role shareholders are playing in these overall context. And that's where you may come across a situation where the board may comprise of members who are also the shareholders. Now, if that happens to be the case, we have to see those who are also the members as well as the shareholders, are they influencing, or are they having an influence on the other board members to move a particular decision in a particular manner? Again, the messaging here I'm trying to give here is factual, based on what the reality is. It's a factual exercise for us to determine, but that's which governs your who. Okay. Now, once we have decided the who part, now comes the where part, which is from where these decisions are being taken. So here, what the guide has done, it has taken into cognizance fundamentally various aspects where the when location could be, or the where location could be decided. Now, if you look at very clearly the physical meeting, how usually the board of directors are meeting at what place, and please understand the fact, we are connecting the who with the where. Okay, so who part, if it's the board where we have decided that they are actually taking the shots, they are the ones who are taking the decision, then the question comes, from where have they taken it? That's the place, because in place of effective management, you have the place part, which now plays an important role. We have decided where the effective management is in terms of the decision making, but now we are focusing on the place part. So that's where physical location of a meeting would be relevant for sure. In certain situation now, after COVID, things have become so technologically advanced that we may be ending up having virtual meetings. Now, to this extent, it's not that just because you're having a virtual as well as physical, the emphasis has still been given on the who part, which means a location of a director with having an overriding decision making power, which means if you have certain directors who have this power to override and they are being not being physically present in that jurisdiction and they are taking the shots from other jurisdiction, and in our example if they're taking the shots from UAE, then them having in the UAE is basically an inclination that the poem of such foreign entity can be in the UAE. One has to bear that in mind, and that's where the virtual part is becoming a very important for you to examine in this world. And that's where they have given certain examples in the virtual aspects. If you have gone through the guide, they spoke about the regularity of the virtual and the physical attendance. What's the proportion, how many people are attending regularly or through virtually the board meetings are getting, these meetings are getting attended. Then of course the physical location of the directors who are taking the shots and the virtually who are taking the shots, what sort of influence are they exercising, and of course the number of directors that attended virtually vis-a-vis the number of directors who have attended physically. All those aspects needs to be then plotted out to see to what extent the poem resides where. And of course the lawmakers or the FT has given certain examples in the poem to substantiate the where part. One angle which they've also come out with is the minutes. Now the board minutes, which basically documents where the meeting took place, and critically that particular meeting or the minutes document could prove very valuable if that particular meeting document also emphasizes the rationale for certain agendas being discussed, why certain ideas were ruled out, why a particular idea was adopted. If that particular ideation, the rationality comes out of that paper, it becomes a very good base for you to contest or to contend that yes, my poem resides in that particular jurisdiction, is what the inclination the FT has taken. And of course, the FT has also spoken about the emails, the location of the persons who are ultimately making the decisions, because certain decisions could be through resolutions or through emails. Broadly, what we are emphasizing here is look out the who. Once you have identified the who, then see who is getting linked where in terms of the location. And then the poem then in totality needs to be decided for that particular entity. Now that we have handled who and where, let me just take you through certain aspects which were earlier when we were reading the guides, when we were basically relying on certain OECD or UN commentaries, we were saying them to be secondary factors. But currently this guide has now indicated that these factors may not be relevant at all, which means where the entity has been incorporated may not be that relevant. The registered office, the location of a registered office of that entity may not be relevant for the purpose of the poem, while earlier we were using them or treating them to be a secondary factors. Similarly, where you keep your accounting records. One of the aspects was where you keep your very important accounting records could be a determinative factor for determining where the poem exists. So that's also something which they're saying, as per the guide, this may not be relevant. And location, of course, day-to-day operation should not be anyway mixed up with the effective management, because effective management is key commercial and strategic decisions that we spoke about. Now, can the rule book in totality be so stringent? Do the lawmakers or do the FTA has considered certain flexibility? That flexibility aspect is indeed there in the guide, which means it may so happen that usually the key people who are basically taking the decision may be taking the decision outside of UAE, but in one-off occasions, or there is a reasoning, occasional, where it's a one-off aspect, or occasionally you have come down to UAE and that decision got taken. Is it engraved in stone that, now the poem is in the UAE? The answer is no. That's where those flexibilities also needs to be read through in the overall context. Okay. Certain temporary and exceptional situations that they have basically, taken up. Travel restriction, we all saw what happened during the COVID time. People were stuck in the countries, they were not able to move, mobility was, totally absent. Now, just because you were there in that country and the decision making was happening, doesn't mean that you would determine the poem to be in that country. That sort of flexibility is anyway welcoming. If there are any illegal sanctions, if there is an act of war, so those exceptions, and even, of course, the emergency health conditions that have been, indicated, those exceptions have to be duly accounted for when we are doing this overall exercise. Okay. Next slide, please. Okay. I spoke to you of what the guidance and how the journey on this guidance has been. Okay. We are sitting in October. Rather, November is coming soon. Tomorrow will start November. What is the way forward? And this is not something which I'm just indicating. It's a common question thing which the client will ask as to what we need to do now. Earlier, of course, we have been saying we need guidance, we need guidance. I think reasonably, we may not get any more detailed guidance other than this, the 20 pages that have come through. But that what leaves us here with now? Should there be an assessment of poem? The answer is absolutely yes. I think it's the time now where you need to assess these entities where you believe the effective management resides in the UAE. What will happen? After doing this assessment based on whatever guidance is available on record, if the outcome comes out that, yeah, you may not have a poem in the UAE, problem resolved. Let the country where this foreign entity has been incorporated take care of its compliances, discharge its taxes. But the answer is yes. Is there a way? Can we mitigate this risk? Is there a mitigation strategy around this? And when I say mitigation strategy, I'm talking about under the four corners of the law. We are not saying that we are trying to do something. The mitigation basically means, since it's a concept where you may have the effective management being moved in a legit manner, if that is something which is doable, shouldn't that be looked into? And that's where decentralization can come into play. You can make your subsidiaries in the other jurisdictions autonomous, have the power being decentralized to have their own board and their decision making. Or you may at least have the decision making done by these who people in the locations where these subsidiaries are located. That's something which could be looked into. I also come across situations where majority of these foreign entities may be in tax havens, Cayman, BVI, Jersey. Not to that extent, the question comes, you may not want to, there will be a difficulty in terms of moving the effective management there. But can we see and can we make these entities now re-domiciled into UAE? Of course, the legal angle by virtue of which these structures were created earlier, those have to be duly factored in. But as a strategy, one has to think. And if we believe that the mitigation strategy is possible, then of course, we should explore that. That exercise needs to be taken up. If we believe that is something which is not possible, then as I explained to you in my first slide, you become a resident taxable person. You need to register under the CT law. The timelines for which I've already spoken to you about. One view is it was 31st of May for the entities which are already incorporated prior to 1st of March. And of course, the risk of entity is already sitting on your head. But you have 31st March 2025 coming in for calendar year companies. There you now need to take a call whether you need to get yourself registered. Now, what will happen with this is this foreign entity may end up becoming a dual resident. Now, dual resident has its own nuances, has its own complications, and I will take those complications as part of the tax residence aspect, which I'll be just sharing 5-7 minutes on. So if we can move on to the next slide, please, on the tax residence. Perfect. Now, we spoke about POEM. It was coming under the umbrella of residency only because it was Article 11.3, right? Now, there is a reason that the lawmakers have given you guidance on the tax residency aspect, because the very clear principle that comes out is you may be a tax resident in the UAE, but you may not necessarily be a taxable person under the UAE corporate tax law. However, you being a corporate tax person under the corporate tax law may very well be a resident under the residency, under the domestic law residency. And that domestic law residency is basically Cabinet Decision 85 of 2022. Okay. Which basically follows your incorporation, formation, recognition in the UAE. And the concept that we just spoke about, which is your having a poem in the UAE, you will still make it as a under the domestic law, under the Cabinet Decision 85, you will still be a tax resident for the purpose of this. Now, once you have seen under the Cabinet Decision 85, which is primarily on the domestic law side, you may have DTAs with the countries, and UAE in fact has 142 odd DTAs currently. If I may have to present that number to you, the residency under the respective DTA also defined. And if you typically go by the treaties define residency of a person in terms of whether that particular person is liable to tax in that country, whether it has a legal connection, means that are you incorporated in that country, or you have an economic connection, which is again the poem concept. More or less, the residency aspect goes with, when it comes down to the juridical person, it goes with its liability to pay tax, then its incorporation or its economic connection, which is the poem. However, the DTA have its role to play when it has to determine the overall the residency aspect, and I'll tell you why. If we move on to the next one, please. I'll tell you an ambiguity that comes through, and it's a very unique one. There are many in the treaties, but of course, we thought probably you will always come across a situation where there is a fight between where the particular taxpayer or juridical person is resident of. I'm taking a very simple example. Let me pick up the guide, how the guide has resolved this, and then I'll come to the treaty example that we have taken it for you. Under the guide, they're saying if there is a problem, if there is a argument as to where the taxpayer has to be resident of, you should give emphasis to the place of effective management, which means the economic connection plays a very important role in determining where your residency lies. Now, in situations where you're not able to solve this dispute, or where the treaties are not worded in a manner to say the poem rule will come, you will come across situations where the treaties will say, why don't you go to the mutual agreement procedures? The two countries talk, their competent authorities talk, they decide who should be the resident in this particular situation based on certain criteria that they have in their mind, and they do this outcome, and the outcome comes out. There could be other criteria which the guide has taken through. They're saying the place where the head office is located is something which is one has to see that the other criteria is also one has to see. So this is where the head office location could also come as a role. But the unique example that I want to take you through in this case is the UAE Turkey. If you look at the UAE Turkey DTA, it begins with saying you are a resident of a contracting state where you're incorporated. Okay, by reason of your domicile and residence. Okay, now imagine a situation where you are a Turkey entity. So by virtue of your incorporation, you are a Turkish resident. But now look at the Article 4.3 of the treaty and see from the however side. It says, however, where such person has a poem in one of the contracting state, then the competent authority shall determine who will be the resident, which means under this specific treaty, you are a Turkish incorporated entity, so you're resident in Turkey for sure. You have a poem in the UAE, so you may have a poem in the UAE under the domestic law, then you have a tax residency in UAE as well. The treaty says if this is the situation where you are resident in both, then you go for the map. The map is not that easy. One has to approach to the competent authorities to take that kind of a decision. But this is there. Another example, if I recall, if my memory serves me well, Bulgaria treaty with UAE. It purely goes by the concept of where you are incorporated. It doesn't go by the concept of where the effective management is. So tiebreaker situations will come through. And that's the major problem of the poem where you are a dual resident. And that dual residency is a problem because you may end up paying taxes in both the jurisdictions, and none of the countries could give you credit of it. That's where this debate needs to be settled very properly. Moving on to the next one. TRC. Rakesh mentioned this because we have been getting requests from the clients. Rather, we have gotten the observations from the client that we are unable to obtain a TRC. The FT is not issuing the TRC. They are saying that the period needs to be completed. They are saying that we need to have the audited accounts. How can we have the audited accounts when our year is already undergoing? All those aspects were coming through. But is the TRC an important document? Absolutely yes, because you may cross-border, you may have transactions where you may want to take advantage of certain beneficial provisions in the treaty. How do you prove yourself that you're entitled for that kind of benefit? TRC is the basic document. And that is where, from a UAE standpoint, this is a certificate issued by the UAE tax authority to a tax resident. Okay. Period-wise, it's a 12-month period. It follows for natural persons. We follow a Gregorian calendar for January to December. For your juridical person, it's a financial year concept. Now, the question which I'm wanting to raise here is very clearly, from a juridical person perspective, it has to be, you may apply it for the current period, but you have to have a 3-month window into that period. For natural person, as soon as your conditions of residency are met, you're pretty much okay with that. For government entities, even if you're 1 day into that period, you're entitled for the TRC. Now, this is what the guide stipulates. I am also aware of the situation where the same principles, when we are trying to apply practically, are not helping. And that's where I'll just take 30 seconds or 1 minute to show you as to what has changed after the guide has been issued. We have tried to do this comparison between what the documents were required for a natural person earlier. This was the TRC user guide that was issued in June 2021, and the guidance latest that has come to October 2024. If I just need to be categoric, something which was required all the documents were needed have now been changed to one of the following that you could see in the first part of it. So if you have now Emirates ID or a resident visa for a natural person here I'm talking about, you can still apply for a TRC. Otherwise, earlier you had to have both UAE residence, Emirates ID, passport, and the movement from General Director of Residency in terms of your number of days stay. That part they have made it flexible. They have not emphasizing on all the documents. Most important, continued as is. I may not be repeating myself. The deck is quite clear. You need to have the validated 6 months bank statement. This was something which was pretty much needed for applying the TRC for natural person. This is not something which is there as part of the new guidance. And the portal still needs to be updated to reflect this change, which I'll show you in the next slide. If you look at this very closely, the bank statement for last 6 months is still a field which is there, which has not been deactivated or has not been made optional. So which means in today's context, this change should be coming soon. But currently, while the guide says that it's not needed, but you may face a challenge if you are not having this 6 month statement. Similarly, for a juridical person also, we have done this analysis for you between what was under the old guidance and what is under the new guidance. Point to be taken is, I may not be repeating myself on what documents continue to remain as is. The important change has been the certified copy of the audited financial statement, which was a challenge for many of the taxpayers, that has been now made optional. The validated bank statement for 6 months has been made optional. But what has been made mandatory is you need to now have a certified copy of the MOA. You have to have a certificate of incorporation. The UAE Corporate Tax TRN is essential. And fourth one is for the POEM entity where you have to give a write-up to them. And I can tell you, if you look into the next slide, when you do this comparison, how it has come out to be, you could exactly see bank statement has now been made optional. Audited financial statement tab has been made optional. Memorandum field has been now added. So let me just close this part on the tax residency part, because I know Rakesh has to take you through the interest and the entertainment. But this is the broad overall context. Happy to take questions. We'll see the chat box. Guys will come back to you in terms of what is needed, and then we can take it from there. Thank you. I hope you had at least gotten the gist of what we are trying to communicate here. Thank you, and wishing everybody once again a very happy Diwali.
Thank you, Sandeep. So with that, we've done a little bit of a flip in terms of these two topics as to how we are going to be taking it. We are going to be covering some case studies on interest deductibility and certain practical nuances or instances that we've come across on entertainment expenditure. And I was telling this to my team that hopefully I can make the interest topic entertaining and the entertainment expenditure topic interesting. So with that, let's probably go into the slides and look through some of the case studies, and I'm sure you'll find a lot of value as we move along. Next slide, please. So very quickly, this is a simple summary of all what we know. Some of us as tax professionals probably would have read this over and over again. Some of us as clients would have probably known this when we would have applied this when we are doing our tax accounting rules. There are just a couple of instances that bring peculiar interest to me as I'm talking to you. So if you look at it, within the definition of interest, Islamic financial instruments and any payment on those are also potentially covered as interest, right? Now we've had a practical experience of having a situation where an Islamic financial instrument was supposed to be tested as to whether it is debt or it is equity, because the same treatment or a similar mention of Islamic financial instrument also exists for participation exemption or dividend taxation. So it became so peculiar that in that instance, typically some of these Islamic financial instruments are floated through special purpose vehicles, and the special purpose vehicles apparently do not have full-fledged financial statements, and they wouldn't have prepared AOFI accounts, which are accounts prepared under the Islamic accounting standards. And that is where it becomes interesting that even a simple definition of interest can become quite tricky or challenging when we are looking at a real life instance, right? We'll be talking about 2 or 3 case studies on what grandfathering means, how special interest deduction limitation rules apply to us, and in general, how do you determine deductibility of interest? With that, let's move to the next slide. Just before I take up those 2 or 3 case studies, one interesting feature that the guide brought about, and I would say much needed clarity, right? So if you look at the table on the left-hand side, and this is a typical computation of EBITDA. As we all know, under the UAE Corporate Tax law, thin capitalization is based on the calculation of EBITDA and 30% thereof, which is the threshold for deduction of interest expenditure, or obviously the de minimis, which is 12 million. I'm not going into the base rules, but I just want to show you the key difference that we've observed. So before the guide had come in, right, what was happening is that when the adjusted EBITDA was being computed, interest expenditure on grandfather debt. And what is grandfather debt? Basically, any debt which was taken prior to 9 December 2022. Okay. This debt is grandfathered, which means that on any interest expenditure which is incurred on such debts is not subject to the interest limitation rules. Now, previously, organizations used to, in practice, deduct the interest expenditure while computing the adjusted EBITDA. This is on the premise that this interest is already grandfathered, is not subject to the limitation. Therefore, it should be excluded from the EBITDA calculation. What the guide has now clarified is that even that interest needs to be added back. And therefore, if you see the conclusion or the bottom line, if you see the adjusted EBITDA in a situation prior to the guide, typically it used to be turned out to be 1100 in the example that we have populated. But after the taxable income guide, the calculation reflects it as 1350, which means that businesses practically have a higher base for taking the 30% threshold. So this is a welcome clarification, I would say, because there were interpretational issues in the ministerial decision that drove this formula, right? With that, let's look into some of our case studies. So this is one interesting case study, right? And I'll try and explain the fact in a minute and then probably look at the questions. So company A borrowed money from a bank, which is in the UAE, used that money to make investments in a listed entity and is earning dividend or interest income. And these investments have happened, let's say, before the tax period. At the beginning of the tax period, company A decides to transfer the investments to a free zone company. Basically, it has set up a holding vehicle in the free zone, and therefore it wants that these investments are now held through the free zone entity. The question is that the loan continues to remain with company A, but the investment, which was the eventual utilization of the loan, has moved to the free zone. So now what may happen is that in the future, within the tax period, the free zone may be earning dividends, capital gains, etc. And assume for a moment that for ACO, it could have been partially taxable. For free zone, because of the special rules, it is completely not taxable, the income. The situation that is arising because of this case study is that ACO will continue to incur the interest expenditure, but the income has completely been shifted to the free zone. So the issue for us is whether such interest expenditure, whether ACO will be able to claim a deduction of it. Can the FTA say that in absence of income for which you had taken the borrowing, and in absence of that income, therefore the interest should not be allowed as a deduction? So our take on this situation is there is an obvious answer if you were to interpret the law succinctly and to your favor, but there is a graver concern in this example that we have taken, right? So if you read the law carefully, the law says that the provision relating to disallowing expenses attributable to exempt income does not apply to interest, right? At the same time, the law freely allows borrowings to be taken to make investments. So in that sense, probably on a classical basis, ACO may be able to claim a deduction of this interest expenditure, right? However, what we observe is that through this restructuring, a probable tax optimization has happened. And therefore, and because the free zone is a related party, the question that comes is whether the loan would also move along with the investment. Because in many instances, we've seen that when banks give loans, these loans are absolutely and fully pledged against the security which is bought. All the income that is earned from the security has to be used to repay the loan. So it is almost a direct correlation. And therefore, the concern here is that from a transfer pricing perspective or from a anti-abuse perspective, whether the loan should have also moved to the free zone or not. This requires a fact-specific evaluation in terms of what are the loan agreements looking like? What is the business of ACO? Is it purely into investment or did it have any other business as well? Are the funds fungible? And so on and so forth. But the idea of this case study was just to let you know that while organizations have practically performed some of these restructuring, they just need to be very careful in their position on deduction of the interest expenditure. Sorry. With that, let's move into another case study. So this is another simple one in terms of the facts, not very complicated. The company is in the mainland, which is ACO. It has taken a loan from a free zone company. In all likelihood, it is its related party. And it has used this money to make investments in a listed entity or an unlisted entity, whichever way you take it, or a foreign security. The investment is more than 5%, which means that any income that ACO will earn from these investments will not be subject to tax, right? The question is whether ACO should be entitled to a deduction of this interest. And here we just need to refresh that within the UAE tax law, there are two provisions which deal with disallowance of interest expenditure. One is the general interest deduction limitation rules, and the other one is the special interest deduction limitation rules. I've given a bit of a theory in the earlier slides, but very simply put, what the special interest deduction limitation rules say is that if you borrow debt to either pay dividend or invest in a capital of a related party or do other forms of acquisitions or repayments to shareholders, then such interest expenditure is not allowable. So we have a classic case where ACO has actually borrowed the loan purely to make an investment in the capital of BCO. The question is whether the special interest deduction limitation rules will apply or not, right? Our take on this one is, if you look at the special interest deduction limitation rules, they cover 4 scenarios. And to our understanding, all the 4 scenarios refer to something called as a related party. So if ACO would have borrowed funds to invest in a related party, invest in capital of a related party in this case, then the special interest limitation rules would have applied. In the example that we have beforehand, our view is that because BCO may not be considered as a related party, assuming there are no other facts around us, this is a plain vanilla portfolio investment. On the basis that BCO may not be construed as a related party, there is a view for ACO to claim deduction of the interest expenditure. However, if we just flip this question, right, and if we look at question number 2, which is if BCO was a subsidiary, or if BCO, let's say, for example, the stake was at about 48%, and by acquiring another 5.5%, BCO becomes a subsidiary or a related party of ACO. In that case, because of the special interest deduction limitation rules, the interest expense which is incurred on this loan to make this acquisition will be subject to disallowance. So much so that if there were other loans which were taken in the past for the purpose of making the investment, probably even those loans would get tainted and would be subject to the disallowance that we are talking about. So this is one interesting aspect around how the special interest deduction limitation rules apply, right? With that, let's take the last case study on the topic on interest expenditure, and then we'll take the last 5 minutes of our session on the entertainment expenditure. Now, this is a hard reality, I would say. We've seen a number of organizations have this kind of a peculiar challenge. So I spoke about grandfathering, right? So this case study is on grandfathering, where very simply put, loan was taken between, or the loan was exchanged between 2 related parties prior to 9 December, in this case in 2020. There was interest, but the interest was short of arm's length. So the interest rate was 3%. And the arm's length interest rate that the parties have decided today, based on a benchmarking exercise, is 5%, right? Both the companies are in mainland. and they are taxable at 9%. Now, the question is twofold. What is the income which is taxable in the hands of PICO? And what is the interest which will be deductible in the hands of QCO, which is the payer of the interest expenditure? If you look at transfer pricing norms, the UAE Corporate Tax Law transfer pricing norms, it will mandate PICO to offer the interest income at 5%, right? Because the transaction is admittedly not at arm's length. And even our tax return filing forms today require us to disclose if our particular transaction is not at arm's length, it needs to be disclosed upfront, including the potential adjustment, right? However, from a QCO's perspective, because that additional interest expenditure is to be paid, the question is, can QCO claim grandfathering even for the additional interest that it will pay, which is 2%? Now, remember, all of this is being done because of the requirements arising out of the UAE Corporate Tax Law. Otherwise, in substance, there is no tax-based erosion that is happening over here because both the companies are mainland entities and are subject to tax at 9%. So this presents a real-life challenge for a lot of organizations which have intercompany loans, which were probably existing since years. And if they were to benchmark their interest rate to market rates, how do they assess the taxability in the hands of the recipient, the deductibility in the hands of the payer? How does grandfathering apply? Whether it will apply to the entire interest of 5% or will it only apply to 3% because of the ministerial decision, the way it is written? Or would they lose the entire grandfathering? Do they have an option to write to the FTA to seek a private clarification? Should they do nothing and just stay put with 3% and let the FTA do what it has to do and then live by the sword? So there are multiple issues or options that arise out of this case study. The idea of this conversation is not to find an answer which does not probably exist in black and white, but to ensure that businesses are aware of this and we are sort of aware that there could be certain instances by which this issue could be solved. But obviously, the fact is that this is a real life instance and therefore needs cognizance, right? With that, interesting discussion on finance costs. Let's quickly move to entertainment expenditure. With the year sort of coming to a close and the sun setting in, as I say, and winters sort of coming in, a lot of organizations, businesses have ramped up their events, activities, with a lot of festivals, etc. coming around. We will obviously observe a lot of entertainment expenditure that is being incurred. The idea of this slide is very simply put. If you see what entertainment expenditure is and what is the rule around entertainment expenditure, which is 50% of your entertainment expenditure which is incurred towards customers, suppliers, shareholders, or businesses or business partners is deductible to the extent 50%. There are about 3-4 things that we've observed for businesses. One is interplay with corporate tax and VAT. What I have seen is that the VAT legislation does not treat entertainment expenditure exactly the same as corporate tax, and therefore businesses need to be more prepared or planned in terms of how they need to treat entertainment expenditure for both laws. Accounting, obviously it becomes simple or difficult depending upon how the chart of accounts are codified, and most businesses are looking at creating multiple codes, at least at a minimum to one which relates to employees and the other one which relates to non-employees, to dissect the 50% and the 100%. I'll talk about apportionment and the fact-specific exercise by way of the chart that I will explain on the next slide, please. So when we've looked at the recent guide which was issued about a couple of months ago on computation of taxable income, and that is where for the first time, probably in our view, the FTA nicely and more importantly for the benefit of the businesses summarized how they will treat entertainment expenditure as, especially in the context of things like expenses which are incidental to business, or businesses which are into commercial hospitality itself, like hotels, or if you are performing marketing and advertisement expenditure like trade shows and so on and so forth. So the way we've seen is that if entertainment expenditure is incurred for non-business purposes, it is 100% disallowed. If entertainment expenditure is incurred for employees, it is 100% allowed. Thereafter, if entertainment expenditure is incurred for non-employees, provided it is incurred for business, there are about 4 baskets that we've observed from the guide: incidental to business, commercial hospitality, marketing and advertising, and others. 3 of the cases reflect a 100% deduction. The last basket reflects a 50% deduction. Let's just see some of the examples in the next slide, and then look after what are the practical instances or observations that we've seen. So not taking each example, but this is a summary of what the guide has written. And maybe I'll spill over by about a couple of minutes because we started a couple of minutes late, given that we were expecting participants to join in. You'd see a lot of theory over here on the slide, but very simply put, there is this fine difference between having a business lunch with clients in office versus having a business lunch outside office. And there is this distinction between 100% and 50%. Then there is this interesting distinction between organizing a trade show or participating in a trade show, but at the same time providing meals or refreshments there to your client. So a large part of your expenditure could be 100%, but to the extent meals and refreshments are incurred, that could be subject to 50%, right? There is also an example around personal expenditure, which is absolutely not related to business, so that gets disallowed 100%. Concert tickets, etc., F1 coming in, a lot of these other events happening in, etc. If you're sponsoring those tickets for your vendors, customers, suppliers, be aware we are only talking about 50% deduction, right? So that's the theory around how the law says. One difficult thing that I've observed while reading that guide is that guide, almost like a naysayer, if you read the guide firsthand, it will say yes, no, yes, no, yes, no. It almost writes the guide, in 150, 150, 150, 150. So it becomes very difficult for a layman to read the guide and come up with a simple answer. But probably some of these charts and these illustrations that we have given could help you. With that, let's just look at some of the practical instances or nuances that we've seen. Next slide, please. So about four examples. So let's say if a business were to give gifts to non-employees. So let's say, for example, at the end of Iftar or at the end of some of these festivals, Christmas around the corner, let's say a business decides to, send gifts to the employees of all their customers, which could be branded stationery, mugs, posters, could be anything else. How do you treat these gifts? Would they be considered as entertainment expenditure subject to 50%? Would they be considered as personal gifts and therefore not allowable at all, right? Or would they be fully allowed on the premise that what you're doing is actually marketing and branding your business, right? So we've observed all 3 instances, and based on a peculiar fact as to whether you have really gifted as luxury item versus you have gifted a meal box versus you have gifted a branded item, the answers could vary between full disallowance versus 50% allowance versus 100% allowance, right? Let me take another example on contractual obligations. So let's say, for example, you called an auditor in your office who's flown in, let's say, for example, from Europe, and he's staying here for about a week, and you've sponsored his stay and meals, etc. The question is whether you would disallow such expenditure. Our view is that as far as contractual obligations are concerned, they shouldn't be looked at as entertainment, because if you wouldn't have incurred this expenditure, the auditor would have probably charged you as OPs. Let's look at CSR versus entertainment. So let's say, for example, a business, sponsors a marathon or a charity event or a gala dinner. How do you treat? So there is a fine line between, rules around CSR under the corporate tax law, because there are peculiar rules of how a donation to a non-qualifying public benefit entity is treated versus how do you treat it for entertainment. And once again, it goes back to whether you are doing any marketing, brand promotion, publicity or not, right? So that interplay is important. The stage today is not to come up to a conclusion, but just to be aware that some of these events could be peculiar, right? Lastly, industry specific cases, very simply put, let's just take one example and then we draw close to the conversation. Let's say there is a sports event management company, right, who's organized an event which is, let's say, as big as NBA or as big as a music concert that happened, right, recently. Now, a lot of participants, delegates, etc. have come in. Now, for this sports management company, it has incurred all of these expenses. In our view, these shouldn't be viewed as entertainment expenditure merely because the way the law is written, because the law creates a deeming fiction, but we need to test such business cases differently. So I think with that, I hope we've had a lot of fun in terms of these 4 topics that we have discussed. I've run out of breath, so I'll wish all of our participants happy Diwali and a lot of festivities. Thank you so much for being active listeners. Uh, Close to 20 odd questions have come in on the chat board. We will try and respond to them offline. And thank you so much, Sandeep, for being an amazing co-host. Thank you so much to my team who have been the backbone in preparing all of this deck. And wish you all a very good day.
Thank
Take care.
you.
Bye-bye.
Thank you, everybody. Thank you. Bye-bye.